You know what bothers me when I look at the way most people handle money? It is not that they make bad investments. It is that they make those investments in the wrong order. They put money into the market the way a gambler drops coins into a machine, hoping the next pull gives them a prize, while the rest of their financial life is leaking underneath them. They may have credit card debt charging them 22% interest. They may have no emergency reserve. They may be leaving free employer money unclaimed. They may be putting dollars into taxable accounts while ignoring the tax shelters sitting right in front of them. And then they wonder why they are not getting ahead. That is like trying to fill a bucket with water when the bottom of the bucket has holes in it. The problem is not effort. The problem is sequence. In investing, as in life, the order of operations matters enormously. A good decision made in the wrong order can become a bad decision. A smart investment made before you have stability can turn into a forced sale at exactly the wrong time. A clever stock pick can be completely overwhelmed by high-interest debt compounding against you every month. And a person who thinks he is investing may actually be feeding two machines at once. One machine building wealth slowly and another machine destroying it faster. I have spent much of my life thinking in systems when a system produces poor outcomes for many intelligent people. The first question is not, are those people stupid? The first question is, what is the structure that is causing them to behave this way? In personal finance, the structure is clear. People are taught to chase excitement before they are taught to build foundations. They are taught to ask, what should I buy? They are not taught to ask, what should I do first? That distinction is the whole game, because if you do the right things in the wrong order, you can still end up with a weak life. If you do the ordinary things in the right order consistently with discipline, you can build a strong one. So I want to walk you through the proper order, not the glamorous order, not the order that gets people excited at parties, the proper order, the sequence that reduces fragility first, captures guaranteed returns second, minimizes unnecessary tax drag third, and only then gives you the freedom to take broader investment risk. Most people do the opposite. They start with the most flexible, most exciting, most dangerous part of the system. They buy individual stocks, they buy crypto, they buy whatever is moving on a screen. They ask whether they should invest in a new technology fund while a credit card company is charging them a rate that most world-class investors cannot consistently beat. That is not investing. That is a person trying to look sophisticated while ignoring arithmetic. The first principle is simple. Before you try to grow money, you must make sure life cannot force you to destroy your own plan. That is why the first step is an emergency fund. I know this sounds boring, but boring is often where the real power is. A strong life is not built only from great upside. It is built by removing the events that can knock you out of the game. An emergency fund is not just money in an account. It is a shock absorber. It is what prevents a broken car, a medical bill, a delayed paycheck, or a family problem from turning into a credit card balance, a forced stock sale, or a decision made under panic, and panic is expensive. When people do not have reserves, life controls their timing. If the market is down and they need money, they sell. If a bill arrives and they do not have cash, they borrow. If a job is lost and there is no buffer, every decision becomes emotional, short-term, and defensive. That is how financial stress compounds. It is not only the emergency itself, it is the poor decisions, the emergency forces. This is why I would not start by asking how to maximize returns. I would start by asking how to reduce the probability of ruin. A person with no emergency fund is fragile. A person with even a modest emergency fund is less fragile. And that difference changes behavior. There is data showing that many Americans have very little saved for emergencies. Some estimates say that 1 in 3 Americans has no emergency fund at all. The median emergency savings number has been reported around only a few $100s. Whether the exact number is $500 or $600 is not the main point. The point is that most people are one ordinary problem away from financial disorder, yet those same people often want to discuss individual stocks. That is the wrong sequence. It is like asking whether you should buy a high-performance car when the car you already own cannot get you to work. The first goal is not to become rich. The first goal is to avoid being easily broken. So I would build the emergency fund in stages. Do not make the mistake of turning this into a giant abstract target that makes you feel paralyzed. Start with the first $1,000. That small amount will not solve every problem, but it changes the psychology. It covers many minor emergencies. It creates a little space between an event and a crisis. Then build toward 1 month of living expenses, then build toward 3 months. For some people, 3 months is enough. If you have a stable job, predictable income, good insurance, and few dependents, 3 months may be adequate. If you are a freelancer, a business owner, someone in a volatile industry, or someone with people depending on you, you may need 6 months or more. The correct number depends on the nature of your risks. This is how I think about money, not as one size fits all advice, but as a set of principles applied to your circumstances. The principle here is resilience. You need enough cash to prevent life from forcing you into bad transactions. Once that is in place, the next step is to stop the guaranteed losses that are compounding against you. That means high interest debt. This is where many people sabotage themselves. They want to invest, while carrying debt that is charging them 18, 22, or 28% interest. That is not rational. If you pay off a credit card charging 22%, you have effectively earned a guaranteed 22% return. There are not many legitimate investments in the world that can guarantee that. Certainly not public equities, certainly not the average investor's stock picks. So if someone says, should I invest while I still have credit card debt? I would say, look at the math first. If your debt is compounding against you at 22% and your investment may earn 7 or 8% over a long period, the spread is destroying you. You are not building wealth. You are arbitraging yourself in the wrong direction. The credit card company is earning the high return. You are hoping for the lower one. That is a bad deal. High interest debt is financial gravity. It pulls you down every month, and the longer you ignore it, the more energy is required to escape it. So after building a starter emergency fund, I would attack high interest debt aggressively. List the debts, write down the balances, write down the interest rates, pay the minimums on everything, then send every extra dollar to the debt with the highest interest rate. This is the debt avalanche method. It is the most mathematically efficient approach because it eliminates the highest cost liability. First, some people prefer the debt snowball method, where they pay the smallest debt first for the psychological win. That can work if you need motivation. But if we are talking strictly about the best economics, the avalanche is cleaner. You remove the most expensive problem first, and when you do that, your system becomes less fragile. Now, there is one important exception, and this exception matters because it shows why the sequence is not just a slogan. If your employer offers a retirement match, you should usually contribute enough to get the full match even before you finish paying off high-interest debt. That sounds contradictory until you do the math. An employer match can be an immediate 50% or 100% return on the dollars you contribute, depending on the structure. If your employer says, put in this amount and I will add free money on top, that is a very rare thing. It is not a forecast. It is not a market opinion. It is not a hoped-for return. It is money placed into your account because you followed the rules of the plan. Most people should not walk away from that. Imagine your employer matches 50 cents on the dollar up to 6% of salary. If you earn $50,000 and you contribute $3,000, your employer may add $1,500. That is a 50% immediate return before the market does anything. If the match is dollar for dollar, the return is even greater. There are few opportunities in financial life that have that kind of built-in advantage. So the order is nuanced. You build enough emergency cash that you are not fragile. You contribute enough to capture the employer match. You attack high-interest debt, then you move deeper into tax-advantaged investing. That is the correct structure. Most people skip that structure because it is not exciting, but what matters is not excitement. What matters is repeatable advantage. Once the high-interest debt is gone and the employer match is being captured, you enter the tax optimization zone. This is where a lot of ordinary investors lose enormous amounts of money without realizing it. Taxes are not just something you deal with once a year. They are a major force in long-term compounding. Every dollar you unnecessarily give away is a dollar that cannot compound. And over decades, small differences in tax treatment and fees can become very large differences in outcomes. This is why I would not rush straight into a taxable brokerage account. A taxable account is flexible. It is useful, it has a place, but it usually should not come before your major tax-advantaged options. The next step is typically an individual retirement account. An IRA gives you control. That is important. Many employer plans are useful because of the match, but after the match, some of them have limited investment menus and higher fees. Not all, but enough that you should examine them carefully. A good IRA can give you access to low-cost index funds, and ETFs. Fees matter because fees are a negative compounder. A 1% or 2% fee may sound small in 1 year. Over 30 years, it can quietly remove a very large part of your wealth. It is like a small hole in the bucket. If you do not notice it, the system leaks. For 2025, IRA contribution limits were $7,000 or $8,000 for those age 50 or older. Those limits are not enormous, but the account is powerful because of the tax treatment and the control it gives you. Then comes the choice between traditional and Roth. This choice is often made more complicated than it needs to be. The core question is whether you prefer to pay taxes now or later. A traditional account gives you a tax deduction today. You put money in before tax, let it grow, and pay taxes when you withdraw in retirement. A Roth account makes you pay taxes today. Then the money grows, and qualified withdrawals later can be tax-free. The right answer depends on tax rates now versus tax rates later. If you are currently in a high tax bracket and expect to be in a lower bracket in retirement, traditional may make sense. If you are early in your career and in a lower tax bracket, Roth may be very attractive because you pay today's lower tax rate and protect future growth from taxes. But there is a problem. No one knows future tax law with certainty. A young person may earn more later. A high earner may retire into a lower bracket, or tax rates may rise broadly because the government needs revenue. This is why tax diversification has value. If you are unsure, having both traditional and Roth money gives you flexibility later. You do not need to predict the future perfectly. You need to build a system that can handle more than one future. That is a principle I care about a lot. A robust system is one that can survive different environments. Now, if you have access to a health savings account, this is where the sequence becomes especially powerful. Many people ignore HSAs because the name makes them sound like a small medical account. That is a mistake. For eligible people, an HSA can be one of the most powerful investment vehicles available. It can have 3 layers of tax advantage. You may get a tax deduction when you contribute. The money can grow tax-free while invested. And withdrawals for qualified medical expenses can be tax-free. That combination is extraordinary. Traditional retirement accounts generally give you tax benefits on the way in or the way out, but not both. An HSA can provide benefits at multiple points for 2025. HSA contribution limits were $4,300 for individual coverage and $8,550 for family coverage. You need to be enrolled in a qualifying high-deductible health plan to contribute. That plan is not right for everyone. If you have high medical expenses or need a different insurance structure, the HSA may not fit. But if you are eligible, healthy, and able to pay some medical expenses out of pocket, the account can be used strategically. Here is the concept: you contribute to the HSA, you invest the money if the account allows it. You pay current medical expenses with other cash if you can. You keep the receipts. There is generally no time limit on reimbursing yourself for qualified medical expenses, as long as the expense occurred after the HSA was established and the records are kept properly. That means a medical bill today could potentially become a tax-free reimbursement years later. The account can keep compounding in the meantime. That is powerful. And after age 65, the HSA becomes more flexible. Non-medical withdrawals are treated more like traditional retirement account withdrawals, generally taxable but not subject to the same penalty. Medical withdrawals can still be tax-free, since healthcare costs in retirement are a near certainty. Building tax-free money for that category can improve the entire retirement system. This is what most people miss. The HSA is not just about healthcare. It is about matching a future unavoidable liability with an account that is built to handle that liability efficiently. If you max out an HSA for decades and invest it well, the result can be meaningful. The exact outcome depends on market returns, contribution limits, and time. But the principle is clear: tax-free compounding for future medical expenses is very valuable. After the IRA and the HSA, the next step is to return to the employer retirement plan and contribute beyond the match. The 401k is not always perfect. Some plans have high fees, some have poor investment options, but the tax shelter is still valuable. For 2025, the employee contribution limit was $23,500, with a higher limit for people age 50 or older because of catch-up contributions. For someone who can fill that space, the long-term tax advantages can be substantial. Between an IRA, an HSA, and a 401k, a disciplined saver can shelter a large amount of income from current taxation that matters, because compounding is most powerful when it is left alone. Taxes interrupt compounding, fees interrupt compounding, debt interrupts compounding, emergencies interrupt compounding. The whole sequence is designed to remove interruptions. Emergency fund first, so life does not force bad decisions. High interest debt next, so guaranteed losses stop compounding. Employer match, so free money is not missed. IRA and HSA, so tax advantages and control are used. 401k beyond the match, so more money compounds inside the tax shelter, then, only after that, taxable investing. This is where most people want to start, but it is usually where they should arrive later. A taxable brokerage account is useful because it is flexible. You can invest without contribution limits. You can use the money before retirement age. You can build a bridge if you want to retire early. You can save for a house, a business, or a future opportunity. You can buy index funds, individual stocks, bonds, or other investments. That flexibility is valuable. But flexibility can also create problems. When people see too many choices, they often confuse access with wisdom. They trade too much. They speculate too much. They trigger taxes unnecessarily. They chase what is popular. And every time they sell at a gain, the tax system takes a piece. Every dividend may be taxed. Every realized gain may be taxed. That tax drag slows the compounding engine. It is like running while carrying friction. You can still move forward, but not as efficiently. This is why taxable accounts should be used thoughtfully. They are not bad. They are simply less tax protected. For long-term investing in taxable accounts, tax-efficient index funds can make more sense than high turnover strategies. Holding periods matter. Asset location matters. You generally want to avoid unnecessary realization of gains. You want to be intentional. Taxable investing can be a powerful final layer once the foundation and tax shelters are being used properly. But if you jump to that layer first, you may leave a lot of advantage behind. I want you to see the full pattern. Now, most people think wealth building is about finding the best asset, that is only partially true. Wealth building is about building the right system in the right order and then staying with it through time. An average investment inside a well-designed system can beat an exciting investment inside a chaotic life. Because the well-designed system survives, it has cash reserves, it has less expensive debt, it captures free money, it reduces taxes, it lowers fees, it minimizes forced selling, it compounds. The chaotic life may have exciting positions, but it is fragile. A bad month can break it, a job loss can force liquidation, a medical bill can create debt, a market decline can trigger panic. Fragile systems lose not because they never have good ideas, but because they cannot hold them long enough. This is a principle that applies far beyond money. In markets, the biggest gains often come from surviving through bad periods in business. The companies that compound for decades are usually the companies that can endure stress without being forced into desperate decisions. In life, people who build resilience first create the freedom to take intelligent risk later. That is why this order matters. You are not just arranging accounts, you are designing behavior, you are making it easier for your future self to do the right thing when circumstances become difficult. And circumstances will become difficult. The market will fall, an expense will surprise you, a job may change, a family situation may demand cash, taxes may rise. Inflation may reduce purchasing power, the world will not move in a straight line. So your financial system should not depend on the world being easy, it should be able to handle stress. That is the real purpose of the sequence. Start with protection. Then remove the highest cost liabilities, then capture guaranteed incentives, then use tax shelters, then expand into flexible investing. That is the order. The reason people resist this is psychological. They want the reward before the discipline. They want the portfolio before the foundation. They want the upside before they have removed the downside. But money punishes disorder. It rewards clarity, patience, and structure. Let me put the sequence in plain language the way I would explain it to someone who wants the principle, not the noise. First, build enough emergency cash so that ordinary life cannot push you into debt or force you to sell investments. Second, get the employer match if it is available, because refusing guaranteed free money is rarely wise. Third, destroy high-interest debt because it is a guaranteed negative return compounding against you. Fourth, use an IRA because control low fees and tax advantages matter. Fifth, use an HSA if you are eligible because it is one of the strongest tax structures available for future healthcare costs. Sixth, increase 401k contributions beyond the match because more tax advantage compounding can improve long-term outcomes. Seventh, use taxable accounts for flexibility, early retirement bridges, large future goals, and additional investing after the major tax advantages have been used. That is the system. It is simple, but simple does not mean easy. The challenge is not understanding it. The challenge is executing it while the world tries to distract you every day. Someone will tell you about a stock that could double every week. Some asset will be trending every month. There will be a story that makes disciplined investing feel too slow. But slow and correct often beats fast and confused. A person who follows the sequence may feel boring for years. Then one day, that person has no credit card debt, an emergency fund, a retirement account growing automatically, tax advantages working quietly, medical money compounding in an HSA, and a taxable account providing flexibility. That is not luck. That is order, and order compounds. The most important thing is to stop measuring financial sophistication by how complex your investments sound. Complexity is easy to create, robustness is harder. A person with a simple, low-cost, tax-efficient portfolio and a strong foundation may be far better positioned than a person with 10 complex ideas, no reserves, and high-interest debt. The financial world rewards the people who can stay in the game, not the people who sound the smartest in the short run. So before you ask what to buy, ask what order you are following. Before you chase return, ask what guaranteed losses you still have. Before you open another taxable account, ask whether you have used the tax shelters already available. Before you try to optimize the top of the house, look at the foundation, because in the end, the purpose of money is not to impress strangers. It is to give you stability, choice, and freedom. And freedom is not built by gambling on the next exciting thing. It is built by creating a system that keeps working when your emotions, the economy, and the markets are all trying to pull you off course. That is the smartest order to invest your money. Not because it is exciting, because it is durable. And durable systems are what create lasting wealth.